For more than a century, governments across the world have reacted the same way when financial systems begin to break. Different countries, different decades, different political systems. But when pressure reaches a certain point, the response follows a familiar path. In the early 1930s, Americans were ordered to surrender their gold. In wartime Europe, citizens were compelled to give it up to fund military expansion. In Britain, Australia, France, India, Italy, and Japan, private gold ownership was restricted, banned, or criminalized entirely. 8 nations. 8 separate moments in history. Yet every case unfolded through the same sequence of events. And today, in 2025, the conditions that existed before those moments are visible once again. This is not about predicting prices or guessing the future. It's about recognizing a historical pattern that has already played out repeatedly. When governments face debt levels they cannot realistically repay. When citizens hold gold or silver, they hold value that exists outside the monetary system. These metals cannot be created by decree. They cannot be diluted with a keystroke. And that becomes a problem when governments need to inflate. Inflation only works if people are forced to stay inside the currency. If there is an escape valve, if citizens could move wealth into something outside the system, then inflation loses its power. That's why, during severe crises, governments move to close the exits. History shows that this process unfolds gradually, not suddenly. It begins with stress. Debt expands faster than economic growth. Confidence in currency weakens. Banks begin to wobble. Capital quietly looks for the door. These pressures build for years, before any official action is taken. Then, once conditions deteriorate enough, emergency measures are introduced. Not framed as confiscation, but as protection, stability, fairness, national interest. In the United States in 1933, the justification was a collapsing banking system. Banks closed their doors. Withdrawals were frozen. And shortly after, gold ownership was declared illegal. Citizens were ordered to hand over their metal at a fixed price, under threat of prison. Months later, the government raised the official price of gold by nearly 70%. Those who complied surrendered real money and received paper claims. Those paper claims were then diluted as the money supply expanded. The transfer of wealth had already occurred before most people realized what had happened. The same mechanics appeared elsewhere. In Germany, gold was absorbed into the state as the government prepared for war. In Britain, citizens were barred from owning bullion, while the currency was devalued. In France, gold holdings were repeatedly absorbed during fiscal crises. In Australia and India, long-running bans prevented citizens from protecting savings as currencies lost purchasing power. In Italy and Japan, gold was requisitioned in exchange for paper that was later destroyed by inflation. Different stories. Same outcome. Each time, crisis created justification. Ownership was restricted or criminalized. Citizens were forced into government-set exchanges. Then the currency was weakened or reset, transferring purchasing power away from the public. What's important is that these actions never occurred during healthy economic periods. They happened when governments were trapped between impossible choices. And that brings us to the present. Today, U.S. government debt exceeds $36 trillion. Interest payments alone are approaching levels that rival military spending. Long-term projections show the debt continuing to grow faster than the economy itself. The global monetary order is shifting. The dollar's exclusive role in energy trade has weakened. Central banks around the world are accumulating gold at a pace not seen in decades. Banking stress has already surfaced, with multiple institutions failing in rapid succession. Military expenditures remain elevated. Capital is increasingly mobile and increasingly cautious. At the same time, precious metals have moved sharply higher in a very short period. Gold has risen at a pace that historically coincides with monetary stress. Silver has surged even faster, which often happens when confidence in paper assets begins to erode. These kinds of moves are not normal during stable periods. They appear when markets sense structural risk. But this time, governments don't need to repeat the actions of the 1930s. The system has evolved. Physical confiscation is blunt and visible. Modern tools are quieter, cleaner, and far more effective. Digital currencies allow transactions to be approved or rejected automatically. Capital controls can limit where money flows. Bail-in rules can convert deposits into losses before individuals can react. Tax and reporting rules can make ownership legal in theory, but impractical in reality. The result is the same without anyone knocking on your door. Wealth becomes trapped inside the system. Alternatives become inaccessible. Inflation does the rest. This isn't speculation. Versions of these tools already exist. Some have been tested during regional banking crises. Others are written into law but unused until they're needed. Historically, governments act only once conditions are severe enough that resistance is unlikely. That's why interventions feel sudden, even though the warning signs were visible for years. In every past case, those who recognized the pattern early preserved purchasing power. Those who trusted stability, institutions, and assurances were gradually stripped of it. The pattern does not depend on ideology or morality. It depends on mathematics. When debt reaches levels that cannot be serviced through growth or taxation, inflation becomes the path of least resistance, and inflation requires limiting escape routes. That's why the same sequence keeps repeating. Not because history is malicious, but because incentives don't change. The price movements you're seeing aren't random. They're signals. Markets tend to sense stress long before policy reacts. By the time official measures are announced, the transfer has already begun. This has happened before. It has happened repeatedly. And the conditions that preceded those moments are assembling once again. The question isn't whether the pattern exists. 8 countries prove that it does. The only real question is whether people recognize it while there's still time, or only after the system quietly closes around them, just as it has so many times before. History doesn't need to repeat perfectly to rhyme. And right now, the rhyme is getting louder.